silver thing is bizarre. I mean, it almost doesn't make sense that you would have 5 to 6 years now of deficit of production to demand, the industrial side of silver. They can't mine enough to get it out to match the industrial demand. Okay. 5, 6 years. So the timing is a key issue. It's a technical issue because those fundamentals have been there. And yet silver sat on its butt for 50 years, the last 5 especially. And only was late last year that it finally said, oh, I'm going to get out of here. Okay. So that's kind of weird. So it's really a technical issue there. But it is monetary metal. And when you compare silver, you want to say, I want to buy cheap, not expensive. Well, when you measure silver versus gold, right now it's about 1.5. We divide silver price into gold the way we do. We don't do the ratio scale. But if you divide an ounce of silver into gold, it's like 1.5% of the price of gold. In our weekend report, you saw, we went back and showed, for example, base metals and gold going back to like 1980. That's when silver was $50. Okay. Silver went to 50 again in 2011, still confined in the box for some reason. But you look at like nickel, steel, aluminum, copper, lead, gold. You plot all these charts, and there's this massive parabolic move where we're trading 3 to 10 times higher than we were in 1980. How come silver, the baby monetary metal, but still thousands of years has been monetary metal? I think the Indians are shifting toward it now, in fact. How come it's only $5 above its 1980 high? And we put an arrow on these charts of these, like all these metals, and showed where they would be if they were matching silver right now. They would be all the way down to the bottom of their page, practically. In other words, why is silver not done what all these metals have done since 1980? Trade at many multiples higher than that. Oh, yes, and zigzags and so forth. But I mean, gold in 1980 was $800, $850. It was a peak of that bull market. Silver peaked at 50 then. Okay, where's gold now? You know, it's been trading 4,000 to 5,000 versus an old high at 850. Gee, if silver were doing that, where would it be? You do the math on it, you get the point.
Gold and silver remain in the spotlight as investors watch inflation, central bank policy, interest rate expectations, and global economic uncertainty. While recent price swings have left many wondering where precious metals are headed next, market analyst Michael Oliver believes the bigger story is only beginning. He argues that silver remains one of the most undervalued assets in the market, and that both gold and silver could be entering a new phase driven by long-term monetary trends, not short-term headlines. In this video, we'll break down his latest analysis, compare it with today's market environment, and explain what it could mean for precious metals investors. Let's get started.
The other thing is, if you look at M2, money supply chart, and look at its increase, where was money supply in 1980? Where's M2 now? What's the percent gain in the money supply? Degradation in the money unit. Silver to be at $300 to $500 right now, just to match the decay in the money supply. So silver is a lagged beast. Now, you know, there's arguments why it is. It's not fundamental. It's manipulative. But obviously, those who've been trying to restrain silver haven't succeeded because they couldn't keep it in the box. You know, late last year, we broke through the 50, okay? And we think it's only begun. After all, you broke through a half-century range. You surged for a couple months. That's the end of it? Think about it. Half a century range, you break out above it, and you don't even, you know, when you look at the logarithmic or ratio scale of that range, it's a 10-fold range from bottom to top. $5 to 50, $5 to 50 for 50 years. When you go back and look at other metals using a ratio scale chart, and then look where they are now in that, you've easily doubled the range. If silver doubled its range on a ratio scale, it'd be $500. Why? 10-fold range above 50. 50 times 10 is 500. So again, there's so many numbers that come up with, whether it's against the money supply, matching other metals, the ratio range of silver's range prior and the breakout, if you simply double the range on a ratio scale, all keep coming up with numbers 300 to 500. So now it's not a precise technical level, but it's the kind of thing you should expect. And quite often when these tantrums occur, they even overshoot reality. Which when you've been having an error for 50 years in pricing that no other metals had, and when you want to make up for it, quite often you'll even over make up for it. So don't be shocked by what you see on the other side of this. That's our assessment. The key now is, do we come out of this intermediate process of decline with an upside signal? And I'm telling you right now that not far above today's highs on a weekly close, we'll start to engage those factors to the upside. When you go back and look at some of those metals I mentioned and look at where they had a range for decades as well, like silver, but they broke out of it like in 2005 for copper, 2007 for lead, and gold has continued to make new highs on Egypt bull market, way above the 1980 high. It's after you've had that sharp break that everybody thinks is the end, when you take that out, what's on the other side is usually extremely violent, extremely vertical, and very fast, meaning that the process of the decline shook out so many people that you, in effect, puked out the weak holders of the market. And you've created massive doubt and non-participation. So, only the strong and the appropriate entry-level longs are still with the market, realizing what's going on, the bigger picture. When you get through that and start to go up the next time, especially when it's associated with certain other asset categories perhaps doing the opposite, meaning flushing money out of the stock market, where does it go? Bonds? Where? Can monetary metals, especially if monetary metals start to advance again, which I think they will, then the money flow becomes panic-like, bubble-like, where you literally go vertical very rapidly. You do something that people think is irrational. Well, look at the semiconductors, what they just did over the last 6 months. Things like that. And I think you could see that, and I think you will see that. But it'll likely be associated not with war news, which, by the way, gold goes down on war news. Ukraine-Russia war, March 2022, okay? End of February is when it began. Silver gold peaked in March, went down big. Gold dropped 20% during that war. Okay? And so people who say gold goes up because of global uncertainty, that's total baloney. It goes up because of monetary degradation and central banks pushing the pedal to the floor. And gold knows what's about to happen. And it doesn't wait for the headline, put it that way. Now, on the other side of this congestion zone, when silver and gold re-engage, you're going to start to get headlines that might be associated with reality. Monetary related, financial crisis related. And that's when people will say, oh, that's the reason. And I think it'll be an orgy to buy those markets, and therefore verticality in price. There's not much that would be contrary that I could think of that would counteract that. I don't have any negative levels below or anything like that. So I think we're simply sitting on a time bomb right now with the intermediate factors. And the factors that will come into play that the public is aware of won't be the things we're talking about now. I mean, not that we're talking about, but they're talking about. So that's where I think we are. Silver thing is bizarre. I mean, it almost doesn't make sense that you would have 5 to 6 years now of deficit of production to demand, the industrial side of silver. They can't mine enough to get it out to match the industrial demand. Okay. 5, 6 years. So the timing is a key issue. It's a technical issue because those fundamentals have been there. And yet silver sat on its butt for 50 years, the last 5 especially. And only was late last year that it finally said, oh, I'm going to get out of here. Okay. So that's kind of weird. So it's really a technical issue there. But it is monetary metal. And when you compare silver, you want to say, I want to buy cheap, not expensive. Well, when you measure silver versus gold, right now it's about 1.5. We divide silver price into gold the way we do. We don't do the ratio scale. But if you divide an ounce of silver into gold, it's like 1.5% of the price of gold.
Despite recent volatility, the long-term conversation around precious metals continues to gain momentum. Central banks have remained significant buyers of gold in recent years, while industrial demand for silver continues to benefit from sectors such as solar energy, electronics, and advanced manufacturing. These trends have kept investors focused on the broader outlook rather than daily price fluctuations. Against this backdrop, Michael Oliver believes silver remains historically undervalued. He notes that industrial demand has exceeded mine supply for several years, yet silver spent decades trapped in a broad trading range before recently breaking above long-term resistance. In his view, that breakout could signal the beginning of a much larger structural trend. Oliver also argues that gold and silver are driven primarily by monetary conditions rather than geopolitical headlines. He believes factors such as currency debasement, liquidity expansion, and changing investor confidence play a much greater role in shaping long-term bull markets. Another key part of his analysis is silver's relationship with gold. Historically, silver has outperformed gold during strong precious metal cycles, and Oliver believes a similar pattern could develop if historical valuation relationships begin to normalize. He also sees gold mining stocks as a potentially attractive part of the sector, arguing they remain inexpensive relative to bullion despite improving fundamentals. His broader message is straightforward. Focus on long-term macroeconomic trends instead of reacting to short-term market noise. So, what does that mean for investors?
If you go back to the 1980 peak, silver was 6.5% of the price of gold, its relative value. In the 2011 peak, when silver also hit $50, it was 3.1% of the price of gold. And right now it's 1.5%. So forget the net price direction. But when that spread breaks out, as it did last November, and the pullback has not negated that recently, by the way, if you take that spread up just to the 3.1%, let's get it back to the last 50 years of highs, which is 6.5 and 3.1. Okay. If you even just went to 3.1, you double the value of silver versus gold where it is now. So as gold goes up, silver's going to go up double as much just to get back to where it was in 2011. If it ever went back to the high of the last 50 years, which price is already taken out, but the spread would be at 6.5%. It's like a quadrupling of the price of silver versus where it is now to gold. So our argument is, and by the way, when that spread advances favoring silver, it's always associated with an uptrend in both metals. In other words, silver doesn't advance versus gold in a downtrending metal market. That spread, if it goes up favoring silver, means the net price of both will go up. The same goes with the miners, by the way. And for that same reason, we think the miners are the better place to be in the complex. Now, I know people don't think that. They think miners are dogs. They're terrible. Actually, they've been beating gold for the last 3 years handily. If you do the actual measurements of where they were a couple years ago versus gold, they've gone up more. But they're so low in price value to gold per ounce of gold. Divide GDX into gold, for example, or plot the chart, or XAU index to gold, that they could double to triple in value just to get up to what had been old low levels of value that prevailed for many decades, 1980s, 1990s, 2000, 2008, where, for instance, XAU index right now is just below 8% of the price of gold. Back then, an average price of XAU was 25% of the price of gold. Meaning the miners, despite the fact that they're killing it in terms of making money, they're making so much money per ounce right now versus their cost of production, that if price of miners went back to even a low-end level of where they'd been in the prior decades, the low end of that range had been 17.5%, by the way, we would more than double the miners just to go to the low end of their valuation to gold that prevailed for decades. And we see the technicals for that engaging. And if that engages, that will be our last major buy signal. Because when that spread moves favoring the miners, it always translates into gold and the miners advancing, both net price, with miners gaining more. We're at the edge of a massive breakout that we've shown, and you've seen it in the weekly reports. That when you break out above that, you're going to have the biggest monetary metals panic you've seen ever. As expressed by the miners, suddenly a public realization that miners are dirt cheap per ounce to gold. And I think you'll have an orgy of buying. Well, what does that mean? It means investors will be shifting from one sector of the stock market to this little tiny sector called gold and silver miners. And it will be like a wet bar of soap phenomenon. That's what we think is technically we're on the cusp of. I think after you've had the orgy move upside, in other words, once you've had this volcanic move, which we think is coming, both in relative value of miners to gold, meaning up in both, but miners rampaging more. Same with silver versus gold, regaining old values even. They don't even have to take out the 1980 high, 6.5%. But just getting halfway back there would be major for silver in terms of its price versus gold. Once you've had that volcanic surge, I don't think we're going to top and go back down into a bear trend. You may top and go into a new reality. It's more likely what's going to happen because I think gold is going to, like you mentioned with China, I think gold is not going to be just a trading metal anymore. It's going to become monetary metal here. Oh, monetary metal there. Oh, good idea, monetary, etc. And the crisis will help create that. The fundamental crisis will help create that institutionalization of gold. But also silver has always been money as well. And people like to call it just an industrial metal. It is not. Yes, it does have those attributes, but it is a monetary metal, and it is vastly underpriced to gold. So, but once we have that surge, my own personal investment strategy is this. I'm going to take some profits out of certain markets like miners, not now, but once you've had the surge, and silver, and put them into cash. The issue is, what's cash? You know what my answer is going to be? Gold. So I'm going to move my profits into cash, gold bullion, or equivalent thereof, and relax, because I think a new reality is coming. This is not a normal gold bull market. This is something that will change things that have been institutionalized for the last 100 years. Fiat currencies, central banks will become laughing stock, in terms of what they do and what they've done. Okay. So I think a lot of things will change, and I think gold knows that. I don't have one, frankly. In fact, I'm working right now on our monthly commodity report where we examine all the commodities, all the basic commodities within the Bloomberg. Oil, natural gas, uranium even, it's not in, I don't think that's in Bloomberg, but base metals, grains, cocoa, coffee, sugar, stuff like that. And frankly, it's a pretty unified chorus, which I don't want to throw a dart and say this is the one that's going to beat them all. Yeah, there will be, no doubt. There will be some subcategory within Bloomberg that beats them all in terms of percent gain. But it looks like a wide chorus to me, where maybe the best strategy, if you want to invest in commodities, and I know a lot of people don't want to buy commodity ETFs where it's literally the raw commodity constitutes the ETF, but they want to buy stocks related to the production of grains, like fertilizer companies, ag-related companies, base metal miners, various types of energy companies, etc. Maybe the thing to do is to do a widespread positioning. Oil was a problem for us because we said buy it at $65 in January. And when they exploded on the war news, we said, this is no good. Don't buy this. These guys are going to get killed. Anybody who bought war news at $100 is going to get killed. And sure enough, they got killed. They should have. You don't chase war news. It's always transient. There's reasons for oil to go up that are nothing to do with war. They have to do with its general price level, which is dirt cheap compared to its own history. It's dirt cheap compared to to stock market valuations. It's dirt cheap to anything you want to measure it against. So maybe commodities are going up simply because they're an undervalued asset category, a real-world asset category that has been neglected, underpriced to other competitive asset categories. It is now going to wake up and go up. Because when that monetary excess occurs, when the Fed prints, that goes somewhere. And anytime the stock market is topped and headed down, when they print money, it doesn't help the stock market anymore. But quite often, it always helps gold, by the way, historically. But this time, it could be like the late 70s. where you went into a global recession, stocks were a wasteland for like a decade, but commodities exploded. And I think in general, you can sort of blanket the commodity complex and say, now this is not going to be like gold and silver where there's verticality. I don't think it could be strong, but I don't think it's going to be like the monetary metals. But I think owning unlevered positions in stocks related to commodities, a broad basket, is going to be a great place to be over the next 2 to 3 years. And I think we're at a cheap enough level where you could call it, you're buying low. You're not buying high.
Michael Oliver's message is clear. Keep your eyes on the bigger picture. In his view, silver remains historically undervalued. Gold continues to reflect long-term monetary trends, and mining stocks could benefit if more capital flows into the precious metal sector. While no market outcome is guaranteed, understanding these long-term forces can help investors make more informed decisions. If you enjoyed this analysis, be sure to subscribe and turn on notifications for more updates on gold, silver, and the global economy. Now, it's your turn. Do you think silver could outperform gold during the next precious metal cycle, or will gold remain the stronger long-term investment? Share your thoughts in the comments below. Thanks for watching, and we'll see you in the next video.